Thank you so much for making sense of this number. SIPs crossing the 13,000 crore mark. And of course, to talk about this and a lot more, we have with us Mr. Sunil Subramaniam, who's the MD and CEO of Sundaram Mutual Fund. Sir, thanks a lot for joining us and discussing the trends that we are seeing in the mutual fund industry, this time particularly for the month of October. As you heard Pavitra talk about all the trends that we've seen across categories as well, tell us what your initial thoughts are and what kind of steady rate are you looking at?
So I think the first thing is that the retail investor is retained confidence because the SIP book continues to hold strong and has crossed 13,000 crores. So that's number one. I think as a takeaway, if you look at it, there's no, the volatility in the market is not caused a panic in the retail customer. That's number one. Number two, you correctly pointed out that last month was an NFO heavy month. So the inflows of last month were much higher than this month. This month, the NFOs were much, much less because last month and the month before, the NFOs were coming after a pent-up gap. Because if you recollect, April, May, June, there were no NFOs at all because SEBI had put an embargo due to the pooling issue. And so there was a pent-up, of NFO launches, which took advantage of that and which is now tapering down. Third aspect which you mentioned is that the balance advantage category and the hybrid category are seeing outflows. So the lesser inflows. In the hybrid, I'm not so worried because it's the arbitrage which has seen an outflow, which is an institutional play. There's about 4,000 crores of net outflows in arbitrage. If you take away that, hybrids were also positive. But you mentioned the sharp correction in balance advantage fund. And so I think that's from the last month continuing again shows the confidence. You see, balance advantage had become a very important category in a time when the market was very volatile, when the FIs were withdrawing up to June and then the FIs came back. So the asset allocation recommended by distributors to their customer was park it in balance advantage because you can take advantage of the fund manager's expertise in equity asset allocation. Now, what's happened is fund managers in the balance advantage category have moved from 40% equity allocation to 55 to 65% if you see various balance funds. So the fact that these investors are very smart and they're looking at it, they're seeing the fund managers allocating more to equity, which they're also saying, that means my outlook is fairly good for the Indian economy and for the BPS growth. So let me also shift out from dynamic asset allocation into a pure equity. So now when you look at the pure equity collections, though they are lesser than last month, it's a small cap segment, the mid-max cap segment, which are getting a significantly higher share of the flows. So that points again to a greater confidence around the Indian economy. The fact that though the world is going through a slowdown, there isn't that bad news around Indian economy. Inflation trends are coming lower, government's GST and direct tax collections are coming higher. So I think overall there's a good feeling around it, which is where I would say that the sustainability. And finally, index funds and ETFs, you mentioned about the flows. These are institutional investors, provident funds, right, who are making allocations to equity, right? So that again, it indicates that they are bullish on the Indian market. They are choosing index because by mandate, they have to choose the lowest cost option. And hence institutional play is largely reflected in that. And finally, on the debt side, you correctly pointed out that September was heavy outflow on the liquid due to quarter end balance sheet management by corporates and banks. And this month it's reversed back to normal. So I would say overall, you've captured the trends quite well. And this is my explanation for that. So it gives me confidence that in the months ahead, we're going to continue to see positive inflows from domestic investors into MFs. And hence MFs will continue to be buyers and supporting the market's up move.
Oh, we've definitely seen that play out, right, Sunil? Even at a time when we talk about volatility or investing in these times, it is these flows which are sort of really aiding the market. On the balanced advantage funds, I just want to ask you, like you said that there has been an outflow this time. Last month also we saw an outflow. And maybe investors are now more comfortable moving to pure equity plays. So do you think this is a trend which is likely to continue?
I think as long as the news, I think the festival season demand was spoken about a lot. I think there's good demand. I think India's inflation trajectory, as you see, is coming down steadily. We have had a good monsoon. We have had all the reservoirs full. So Rabi crop is also slated for a good sowing season. So I think overall, RBI has also projected inflation in the first quarter of the next financial year at around 5%. So this indicates that there's not going to be any interest rate hike kind of pressure on the domestic scenario from RBI. And I would also say that the fact that in the US inflation has started dropping means Fed may ease off on rate hikes, which is a positive for flows into countries like India. So I would say that all in all, there could be continuing volatility for the next 3 to 4 months. But I think that the Indian investor has gained so much experience that he now sees as a volatility as a time to buy stocks low. The buy low, sell high is now coming into play. And more the intelligent investor, right, I think is coming to play in being smart about his moves. So that gives me a lot of confidence because there is no bad news on the Indian economy front. I think everything, the data that I see points to a good outlook for the Indian economy. So I think that this augurs well because FIIs, when they return, will buy large caps. And domestic mutual funds will then sell large caps into the FIIs and start buying mid and small caps. So a broader asset allocation, which is what the investor is also doing by increasing his allocation to mid cap and small cap. So I think overall, it's a good story for the broader market.
It's a good story for the broader markets, but they are diversifying their asset allocation as well. So I was just looking at the marginal growth that we saw in the gold ETFs this time around. It was marginal, around 147 crore rupees with an AUM of, for this particular fund or particular segment at 19,881 crore rupees. Do you think this is one segment which will start seeing more traction? You are, of course, talking about strong fundamentals, but still there is some volatility that we're seeing in the global markets. Do you think this could be the safe haven for investors? And this is something they'll start looking at more positively from here on?
I agree with you because see, in the periods up to last month, right, as US dollar was rising because of rate hikes by the Fed, gold was suffering, right? But now that you are seeing that the market is expecting an end of the rate hike cycle sometime next year, post which, if they have achieved their targeted inflation coming down, definitely US growth is going to slow down. And I would say that dollar strengthening will be a reversing trend. So when the dollar starts to weaken a relative basis, right, gold will be a beneficiary. And if you see 1 month gold prices movement, it already started an up move. So I think that it's a correlation to the dollar. Dollar strengthening is negative for gold, dollar weakening is positive for gold, and sovereign wealth funds also do this allocation. When they invest in dollar, they put it on the dollar and put in gold. So that's one important tracker where I would say, yes, gold should form a part of the asset allocation, 5 to 10% maybe, because if this trend of recession continues, you would like to see dollar weakening, then you're going to see definitely gold appreciating. So I would say it's a smart move to have 5 to 10%, not much more than that, in gold at this point in time. The numbers last month also reflect to some extent the Indian consumer Diwali buying, instead of buying jewelry, maybe buying gold, paper gold, just as a matter of a sentimental thing. So that could also account for a small uptick in gold demand.
All right, got that. That is on the gold schemes. Sunil, just coming back to debt for a minute, like we were talking about, last month, of course, looks very inflated because of the quarter-end activity. But how do you expect this to trend? We've been talking so much about being in this rising interest rate environment. Where do you expect to see the debt funds trend in the next couple of months? I'm not talking about just this one, but in the next couple of months.
I think what's happening is that there are two types of debt investors, right? So one is a person who allocates between equity and debt. And there I would expect that debt allocation to be increased in equity because of the increasing confidence. So you will see that balance advantage going out, even that is reflective of that trend, that a greater allocation to equity from a person who's comfortable with both and is planning both. But a pure debt investor, right, compares himself with FDs, right? And within that, there are again two categories. One who's parking his safety capital. That's in the liquid, ultra short-term, right? The other one who treats debt as an asset allocation versus FD and who's looking for a good return. And for that, he needs to have a 3-year view because of the way the taxation is structured. So on a post-tax 3-year basis, given that interest rate hikes have happened, today a 3 locked in. If you're willing to wait for 3 years, I think on a post-tax FD, you're able to get at least 50% more return, which is post-tax FDs are giving you sub 5%, and you will be able to get, say, 6.5%, 7%, which is 35 to 40% as a return better percentage, right? So target maturity funds, right, which are open-ended FMPs in a sort. That is, if you have a target maturity for, let's say, 2027 or 2028, and you stay till then, you will get the yield which the paper is bought at today, which is upwards of 7% today. So if you're getting a 7% yield and with an advantageous taxation, the HNI customers who are looking for no risk, but just want to get a better yield than FDs would start allocating more into debt. So I would expect that target maturity funds should get higher and higher collections in the coming months because these rates are good. Because as I said, the inflation forecast is coming down. So further rate hikes from RBI need not be on the anvil. So as a result, I don't see interest rates going too much higher. There will be a slight 15-20 basis points rise in longer term interest rates, which could be factored in. But I would say that for that kind of investor, compared to FD, it's a good time to lock in. So target maturity funds are the funds which I expect to be the favorites in receiving debt allocations over the next couple of months.
All right, target maturity funds could be the favorite. Sunil, thanks a lot for joining us and taking us through that complete